Hey everyone, welcome to another episode of ADMAIL. This is Adam Bergman, founder and CEO of IRA Financial. I'm here to help you find the answers to the most frequently asked questions from my clients about self-directed retirement accounts. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hey everyone, and welcome to another episode of ADMAIL. I'm Adam Bergman, tax attorney and founder of IRA Financial, and got a great episode for you today. Buckle up, it's going to be a lot of fun. We're going to be talking about self-directed IRA-owned real estate and sales tax. How about a trust versus an LLC for your IRA? And then we will finish up on seller financing and an IRA. Can you do that? So pretty interesting, very interesting episode for you today. So I think you're really going to enjoy it. Really good questions from three super smart people. So without further ado, let's get started. First question is from Paula M. of Salem, Oregon. And Paula wants to know, is my Airbnb property owned in my self-directed IRA subject to state sales tax? And the answer, Paula, is yeah. An IRA will get you around federal tax, generally state tax. But when it comes to local taxes, property taxes, sales tax, the IRA will still, in most cases, be subject to it. Now, some states may have specific exemptions. I suggest you speak to local, counsel or local accountant to help you navigate that. But in most cases, through my 21-year practice of tax law, my experience, you're going to have local taxes like real estate taxes and sales taxes apply to IRA-owned real estate. Now, sales tax generally is not an issue for real estate, except if you're doing, Airbnb stuff. Otherwise, it's just local real estate tax. So again, IRAs will exempt you. You can defer taxes, federally, state taxes on income and gains from your IRA. Also, when you take money out of your IRA, if it's a Roth IRA, so long as you're over 59 and a half and the Roth's been open at least 5 years, it's all tax-free. There's no federal or state tax. Now, if it's a pre-tax IRA, you'll be subject to tax when you pull it out over the age of 59 and a half, federal and potentially state. But as the investment is materializing, as it's in the IRA, not when you are taking it out by way of a distribution, then the income and gain should be exempted from state and federal taxes. However, on local real estate sales tax, property taxes, that will still apply to your IRA-owned investment. So really good, Paul. Really good question, Paula. Super appreciate it. Second question is from Stan B. of Columbus, Ohio. And Stan, actually spoke to Stan, I don't know, a month or so ago. I remember this question vividly. I've been going back and forth between an LLC or a trust for my IRA. Any thoughts? So this is a very general question. I wanted to include it in today's podcast kind of as a introduction. I'll probably do a bunch more videos on this. There's a growing number of people that for some reason want to set up trusts instead of an LLC that would be owned by the IRA. So the typical structure for an IRA LLC is that you set up an IRA, the IRA sets up an LLC, it owns the LLC, let's say 100%. The LLC is managed by the IRA owner, i.e. Adam, it's my IRA, I manage it. I have a local bank account for my LLC. And then my LLC, for example, buys real estate, titles in the name of the LLC. I get limited liability protection, which is important to me. And that means all my assets outside of the LLC are protected by creditors. And for the last 20 or so years, that's been a super popular way to do IRA-related investments. However, probably the last 10 or so years, and I was one of the first to allow my clients to do IRA-owned trusts. So instead of the LLC, the IRA is a grantor and beneficiary of a trust. Now, a trust is not a state formulated or created entity. It's just a piece of paper. It's agreement generally between three parties. Now, the parties don't need to be distinct parties, but you need a grantor, a trustee, and a beneficiary. Every trust needs those three parties. Generally, they could be the same. Most states will respect that, but in this case, the reason for doing the LLC over the trust over the LLC is generally cost. Specifically for California, investors don't want to pay the minimum franchise fee to California of $800. They like to set up trusts, and they think that's going to help them. And the problem is the state of California is super aggressive, and I've seen instances where the state taxing authority will deem a trust to be subject to the franchise fee as well if it's engaged in the real estate activity. So you're not going to get around state tax. The entity will still be subject to state tax. Now, a trust follows at least a grantor trust. That's a trust created by grantor that's revocable. That will file a trust form 1041. You can, if it's a grantor trust, you generally can get exempted from the filing of it. The problem with trusts is each state has specific and in some cases distinct trust rules. So you think you may be smart saving a couple $100 on the setup cost and maybe the ongoing cost because there's no annual LLC administration or franchise fees. Even though most states, the average annual fee is under $150. Some are even zero. The highest is California, $800. Massachusetts, it's $500. Tennessee, $300. So other than those states, like, you're not saving much by doing a trust over an LLC. But what you are going to add is a series of complexity that you may not be even aware of because you may not be knowledgeable on the state trust laws, and whether it's filing a state trust return, a Form 1041, or just some quirky state tax trust rules that apply. In fact, most states that have a state tax also have a tax that applies to trusts. Now, Florida, for example, doesn't have state tax. And if you wanted to do a trust in Florida for your IRA, instead of an LLC, I guess it'd be okay, but you wouldn't get limited liability protection, and you'd only be saving like $140 a year. And you don't get LLC protection. I just don't see the benefit. And I've talked to hundreds of clients over the years saying, like, you sure about this? Like, we'll do it, but you're adding complexity. You may have to file state and federal returns. You may be tripping up some unintended trust rules you're not aware of. Not a lot of accountants want to deal with trusts. They may charge you more than you would even if you had to file a partnership return. You don't get limited liability protection. For what? I just don't see it. Even in California, having a California trust could potentially even subject you to California tax, even franchise fees. So I don't see it. I do the LLC. Again, it doesn't matter to me, right? It'd be easier to do trust because you wouldn't have to deal with annual LLC fees. Clients would appreciate that. Maybe I'd even be able to get more clients, but I just don't see the benefits of the trust. I think gaining limited liability protection, having state law that's established, that's well-versed and well put out there, matters to investors, gives you comfort, standardizes everything. So I'm not a big trust guy. If you want to trust, do a land trust that so you have an IRA, Jones LLC, and then maybe have the LLC do a land trust if you want more anonymity. The big thing with trusts, other than saving costs, is privacy. Right, other than Delaware, Wyoming, you can pretty much find out who the manager of the LLC and info about the LLC. So some people are super private and protective of their identity, and I get it, right? I totally get it with social engineering and all these crooks out there. So what you can do is you can have an IRA on the LLC, and the LLC have a land trust, and then buy the real estate in the land trust. You don't get the limited liability protection, but you do get a lot of privacy. So that's an option, but I would totally have the LLC in there. I still think having a trust could bring about far more complications than any issue it could solve. So Stan, that's my 2 cents, but we've chatted about it, and feel free to email me back or call me, and we can continue our discussion. But I just think the LLC is just easier and safer. Last question on today's podcast from Spencer T. Before I get into it, he's from Raleigh, North Carolina. Don't forget to subscribe if you're watching this on YouTube. Also, give it a like. Really appreciate it. And leave a comment, especially on YouTube. I try to get to all the comments personally. I'll respond to them. I like feedback, good or bad, whatever. You can dislike it too. Like, I learn from feedback. I try to get better every podcast, every video. My goal is to give all you the best content I can. I'm just a lawyer. I'm not a professional podcaster or actor. So I know I can do better. I'm trying. But the most important thing is the content's got to be 100% accurate, and that I can promise you is the case. I may not look like a model or have the delivery of an actor, but I can promise you, if you're listening or watching, you're going to get the right answers to these questions, which at the end of the day is the most important. So going back to Spencer T. of Raleigh, North Carolina, Spencer wants to know, can I sell one of my self-directed IRA properties and do seller financing? And I've done a bunch of these questions before. The answer is yeah, you can do it, Spencer. Not a problem. Again, just make sure the buyer is not related to you, right? You cannot transact with a parent, child, spouse, daughter-in-law, son-in-law, obviously yourself, or any entities controlled by such persons. So if it's a brother, sister, aunt, uncle, cousin, neighbor, friend, whatever, third party, you can sell it to them. You can give them financing. The interest will go back to your IRA without tax. It's not going to trigger UBIT because you're the lender, you're not the borrower. So no problem, Spencer. It's quite common, especially in today's real estate marketplace where interest rates keep climbing. Tough to get a mortgage. So if you want to, sell your property and you're willing to do a cheaper mortgage on it, you may have a better chance of getting your price and selling the asset. So I've been getting more and more of these questions over the last 6 to 8 weeks. So I wanted to include it. This question actually kind of cut the line a little bit and moved it to the top because I think it's relevant and important in today's high interest rate environment where you can do some seller financing to hopefully help sell your asset at the price you want, even in your IRA. So thanks to Spencer, thanks to Stan, thanks to Paula. Really great questions on today's podcast. Thanks to all of you for listening, if you're watching on YouTube. Thank you. Like, dislike, leave us a comment, and subscribe to the IRA Financial channel where we drop 3 to 4 videos a week and 3 podcasts. And obviously you can pick up, this podcast drops every Thursday, wherever you listen to your podcasts. I also do 2 other podcasts, Adam Talks, which is every Wednesday, and Ad Bits, which is every Tuesday, which discusses a bit of information on various self-directed retirement, investment, alternative asset topics. So thanks for spending some time with me today. I hope you have an amazing holiday season, safe, and you get to spend a lot of time with your family. Thanks again, and be well. Take care.